In an earlier video, I talked about the 3 different types of installment agreements available with the IRS. In this video, we're going to talk about what I call a classic installment agreement, and it looks something like this. The taxpayer owes in excess of $50,000, or they've had multiple installment agreements that have been defaulted on in the past. And the IRS is tired of playing games. And so what they do is they require that you submit a financial statement, a collection information statement of one of 3 types. There's a 433-F. It's something of a streamlined form that the automated collection system, ACS, uses when they're the function that's actually working the case and trying to collect the money from the taxpayer. The other 2 collection information statements are the 433A, used for individuals and wage earners, and the 433B, which is used for small business people and self-employed people. The result of those 433F, A, or B is going to determine what the taxpayer actually pays in the installment agreement, or rather, it's going to determine what the IRS is going to look to for the minimum monthly payment available in an installment agreement to that particular taxpayer. Let me give you an example. Let's say the taxpayer owes $60,000, they make $8,000 a month, and after they get done with their collection information statement, it says that the IRS, or the monthly disposable income, according to the IRS allowable standards, is $3,200 a month. Now, I think that number, $3,200 on a $60,000 liability, is basically obscene. But we see results like this all the time when we're dealing with the IRS. How do they arrive at those numbers? Well, I alluded to it earlier. They use what they call allowable expenses. And here's one example. They use a number called the national standard, which stands for food, clothing, and other miscellaneous expenditures. And I looked it up, and for a family of 4, that number is $1,450 a month. It doesn't matter what your income level is. You're allowed up to $1,450 a month for the national standard expenses, food, clothing, and miscellaneous. So that could be really good, or it could be really bad. It depends on where you live in this great big country of ours, the United States of America. So classic installment agreements, in my opinion, are something to be avoided if at all possible. There's oftentimes better collection alternatives than this classic installment agreement where the IRS is going to ask for this big whopping payment. Sometimes if you have a tax professional help you perhaps plan your financial life better, or help you put your financial or your expenses and your income down on the collection information statement correctly, then that can actually help you, because it helps the IRS understand that you don't have this big whopping sum available to pay them every month. If you have questions about this, or really anything else that has to do with tax problem resolution matters, we invite you to visit our website at getirshelp.com.